When we pull up the euro to US dollar exchange rate, we are looking at the daily pulse of global trade. These banknotes represent half of a massive transaction handled by the world's largest banks. On the other side of that massive transaction is the US dollar. The constant tug-of-war between these two economies creates deep momentum, a continuous back-and-forth movement that traders try to measure. To measure that momentum, many use a tool called the 14-Period Relative Strength Index, or RSI. Think of RSI like a thick rubber band. As the market price moves fast in one direction, the band is pulled tighter and tighter. This chart shows a common mistake. Beginners are taught to automatically sell when the line hits the top 70 mark, and buy at 30. But the price often pushes past those lines, causing traders to lose money. Reaching those 70 or 30 levels doesn't mean the market is instantly going to turn around. It simply tells us that the rubber band is dangerously tense, and the current trend is getting exhausted. Prices in finance operate under a principle called mean reversion bias. Think of this as a form of natural gravity. When a price gets stretched too far from its normal average, it almost always snaps back to the center. The euro to US dollar pair is incredibly stable, meaning this gravity is particularly strong. If the price gets too cheap, European companies will buy it up. If it gets too expensive, American companies will sell. That constant global business acts as a counterweight. Knowing the rubber band will snap back is very different from knowing exactly when it will happen. If you try to guess the exact moment a strong trend will reverse, you will likely burn through your savings. To survive, we need a way to look past the price and actually see the invisible forces pulling on that rubber band. We need to know exactly when they are finally letting go. The forces pulling that rubber band are massive financial institutions. Central banks and global hedge funds move billions of dollars a day, providing the actual fuel that drives the market. We can track these major players using a method called volume spread analysis. An institution can easily hide its identity, but it can never hide the massive volume of money it moves. Think of these institutions as invisible giants walking across a sandbox. You might not see the giant directly, but their sheer weight leaves undeniable footprints. This diagram shows one of those footprints on a trading chart. We look at three things: the total distance the price traveled, exactly where it stopped, and the volume bar at the bottom showing how much money changed hands. Here is how they work together. Your RSI tool tells you how much tension is in the rubber band. Volume spread analysis shows you the physical effort the giants are using to hold that tension. Let's look at a specific footprint called stopping volume. A crashing market suddenly stops on a small price movement. That giant volume spike underneath means institutions are absorbing the selling panic. Conversely, in no demand, price drifts upward, but the money changing hands shrinks dramatically. The giants have stopped buying, making the rally hollow. To filter out the noise, professionals use a tool called volume-weighted RSI. This takes that traditional rubber band tension and forces it to prove there is actual money behind the move. This split-screen chart demonstrates divergence. The top line shows the price hitting a brand new high. But look at the bottom line. The volume-weighted RSI makes a lower peak. The price is going up, but actual momentum and money are dropping. When you see the money dropping and you spot a footprint showing the institutions have stopped buying, you have your proof. The giants are preparing to let go of the rubber band. With these tools, we can follow a specific routine. Step 1 is simple patience. Wait for the euro-dollar rubber band to stretch into the extreme danger zones, moving well above 75 or below 25 on your indicator. Step 2 is a matter of strict discipline. Do not blindly enter a trade just because the price is at an extreme. Instead, look closely for specific institutional footprints, like stopping volume. Step 3 is validation. Check your volume-weighted RSI. If it shows divergence, meaning it is dropping while the price is rising, you have confirmation that the massive institutions have walked away. Once all those conditions are met, you execute the trade. You safely ride that natural mean reversion wave right back to the center average. Most everyday traders lose because they try to guess the top or bottom of a market out of thin air. Professional strategists win because they follow the evidence and simply wait for the big players to reveal their hand. By dropping the habit of treating indicators like magic buttons, you protect your capital. Validate the tension with volume, look for the footprints, and let the institutional giants do the heavy lifting for your trades.